Hey everyone, welcome to the KE Report and a company update from Heliostar Metals. We are recapping some drill results from the La Colorada project and mine, as well as the Q1 preliminary results. I am chatting with Charles Funk, President and CEO of Heliostar Metals. Company is traded on the TSX Venture Exchange under the symbol HSTR, on the OTCQX under the symbol HSTXF, and the Frankfurt Exchange RGG1. Now, Charles, we're going to start with the most recent news release from yesterday, May 15th, the drill results from La Colorada. Now, I believe this was the last batch of results from that upsized over 16,000 meter program. And the La Colorado project, this is the one that was restarted, production restarted at the beginning of this year. The headline number from that news release, over 56 meters of 2.88 grams per ton gold. Look, the market reacted kindly to this news release as well. So, Charles, give us just an overview here of that over 16,000 meter drill program at La Colorada, what your takeaways are, please.
Yeah, thank you, Corey. I think the speed at which we've, changed the future of the Colorado has been quite incredible. It was on care and maintenance, residually leaching gold from the leach pads. To think that we've been able to restart it, that we've been able to grow the mine life to 6.5 years, and now we think we can improve the economics on that mine life. I even surprised ourselves with, the combination of more ounces in the gold price and what it's done for us at the project. So there's kind of three ways I think about the Colorado, and there's the stockpiles and the short-term production, there's the expansion of the open pits, and then there's a longer-term future. And I think these results, really sort of powerful combination of some very wide open pit intercepts and also some very high-grade underground mineable intercepts. So if you take the wider open pit intercepts, we think they're going to be quite high margin material. They're the last of that more expanded program that you touched on, and they're going to drive a resource update and a technical report update on the open pit expansions that's due in the middle of this year. Looking forward to putting out those economics that we think will be an improvement from our January report, and that's going to be the backbone of the production from La Colorado going forward. In the short term, then we want to drill off some more stockpiles, and we think we might be able to generate the cash that we need to expand the pits from those stockpiles. So this is something that's kind of new for us and pretty exciting, that we might potentially be able to have enough cash to pay for the expansions. So that's not something we foresaw when we bought it, and a big part of that is a function of the gold price. But we think we can make La Colorado quite capital efficient. So when that tech report comes out, I think it's important for shareholders and listeners to put that in context with the cash that we're generating today. And that means that it's potentially going to be very, very attractive economics for the next few years at La Colorado.
Charles, give us some more insights on this drilling of the stockpiles. Most people hear stockpiles and they think material at surface should be cheap to bring into some sort of mining scenario or add to the production profile. What should we be watching for when it comes to what you could find in these stockpiles?
Yeah, so right now we're mining the junkyard stockpile, called so because the old broken down machinery used to get parked on it. Majority of it was put there when gold was $250 an ounce, and this was considered waste when Eldorado was mining the project. At today's gold price, that's anything but waste. So at the junkyard we drilled it off last year, we showed approximately 20,000 recoverable ounces at 0.2 grams per ton. And the grades are lower, but then the cost to process it's a lot lower because, as you said, it's already been blasted, it's already been moved quite close to our crushing facility. So it's lower grade than the pits, but it's lower cost than the pits. We think there's about 4 million tons in the junkyard. We're mining it and processing it for about $8 a ton. And today at spot, it's worth about $13 a ton. So it's making a significant amount of money for us. And we see the similar potential on the next one that we'll do. Eldorado is slightly bigger. It was put there slightly before, so maybe it's slightly higher grade. We don't yet know, but we need to do the drilling program. So we've got two stockpiles that we're going to drill next. We're already, the tech report on them is quite conservative. we've probably already made more money in Q1 from them than the tech report expected us to make over the whole 12 months. I think that we can recover about 50,000 ounces of gold over 2 years from the stockpile at very attractive margin. And we think that can add, multiple tens of millions of cash to our balance sheet before we do the pit expansions.
So, Charles, as you even said, this higher gold price helping all the financials. Is there a lower gold price that would maybe make you pump the brakes a little bit more on all this expansion going on at La Colorada?
So I can only speak specifically to the junkyard. It's profitable from about 2200 onwards. So you'd have to have the gold price drop very, very significantly for that to be something that we would reassess. And I suspect the rest of the stockpiles are going to be similar. The attraction of the open pits, though, we're talking 0.6, 0.7 oxide gold with significantly high recoveries. So they should be very attractive projects once you do the strip to expand the pits.
So then the other drilling that is going to be going on, these high grain veins beneath and along strike from the open pits. How do these play into near-term production, or will these be most likely added to the production scenario further down the road?
Yeah, I think so. If you put it in sequential order, it's the stockpiles first. They're going to be what we mine over the next couple of years, then another 4.5 years on the expansions of the pits. I think the results, we returned results like 4 meters at 17, just under 9 meters at over 6, 23 meters at 14, although it's got a very high grade intercept in the middle of 380 grams driving that. We will then, in the back half of the year, focus on can we put together underground resources. We think under the Creston pit and the Grand Central pit, there's a lot of potential for that. So that's going to be a focus in the second half of the year, so that maybe as we complete the open pits, then there's an underground future for La Colorada beyond that. There's a lot of exploration upside, in our opinion. It's probably not intuitive for a project that's been in production for over 30 years, but there's almost no drilling outside of the pits, and we see a lot of room for exploration. So we went to production immediately, then we shored up the economics for the open pits. Now we're maximizing the short-term cash with the stockpiles, and then we'll turn our attention to the exploration upside. It's been a very comprehensive turnaround of the La Colorada mine.
Well, and it sounds like it's been all self-funded too, which is a unique characteristic. But when it comes to this upcoming resource update and tech report, will the upcoming drilling be included in that, or is that just encompassing what you have drilled in that 16,000-meter program?
Correct. So the technical report will be on the 2 open pit expansions. It won't include the stockpiles that we're going to drill now. So basically, there'll be a capex step for those open pits. I think we can significantly or largely fund that through the stockpiles. I can't say that definitively until we do that drilling. So whatever the capex number comes out in that tech report, we think we can generate the majority, if not more than what we need, from the cash flow from the stockpiles. And that's not something we truly foresaw a few months ago. It's quite incredible how well it's all come together for us.
All right, let's move over to those Q1 preliminary production results here. It's something you and I talked about early on in April, was how much cash was being added to the balance sheet. And we will go through some of the all-in sustaining cost estimates as well as the average sales price for the gold sold. But overall, when it comes to cash, you do highlight that you closed Q1 with $27 million US in the bank with no debt. Can you break down how much cash was generated just from operations?
Yeah, I think clearly one of the legitimate criticisms or risks for a shareholder of ours was that our balance sheet wasn't strong. And I think we've mitigated that very completely in the last quarter. So when the transaction closed, we had just over 2 million US in the bank in November last year. We grew that to 5.5 at the end of December. We grew that from operations to just under $15 million at the end of the quarter. That includes paying off $5 million of debt that we used to acquire the assets. And then we did the financing that brought in net about 13.5 million. It was 9.5 million Canadian, 13.5 million US after costs and fees. So half of that 27 million cash balance has come from operations, up from almost zero when we bought the assets. It's the combination of we've had some pretty strong tailwinds in that the gold price has been incredibly positive. The ability to permit in Mexico has changed significantly. But I also think and congratulate our team. The team's performed very well and maximised the benefits of those tailwinds.
Now, the cost that you have outlined here for Q1, much lower than what your guidance is for the annual cash costs and all-in sustaining costs. We look at the interim consolidated cash costs, even at the high end, that's under $1,300 per gold equivalent ounce. The all-in sustaining costs for Q1 on the high end, that's below $1,500, again, gold equivalent ounce. But your annual cost guidance range is between 1,800 and 1,900. Talk to us about the performance in Q1. It seems like it came in better than expected.
Yeah, Q1 was a very strong quarter for us. We were where we thought we would be for production. So we got two kind of wins in our cost number. Our costs were legitimately below our budget, but we also produced more ounces than we expected. So we had sort of two positive sentiments to improve that. We've kept the higher guidance, cost guidance number for the year. If I'm right, hopefully we've maybe been a touch conservative there. We've got to restart. We had to restart La Colorada in Q1. We're planning to restart San Agustin in Q4. So we do have some higher one-off costs that feed into that higher number. At this stage, it's looking like I might have been a bit conservative, but let's wait and see how the year plays out. So we think these are sort of life of mine 1800 AISC assets. We've just gone higher this year because of the restart and the one-off cost to restart both assets.
So you are providing some sort of insights into Q2 being lower production. Explain why the lower production is coming in, which also would contribute to you'd expect higher general costs per gold equivalent ounce.
Yeah, there's a couple of key factors. At San Agustin, we're residually leaching, so month over month it produces less because we're not adding new material and we won't be able to do that until Q4. And at La Colorada, there's a bit of a ramp up phase for the junkyard in that you stack and crush material, and it takes a period of time before you start seeing the gold in solution come out of the leach pads. So we think Q2 and Q3 will be a slightly weaker. I wouldn't advise people to just times Q1 by 4, and then we think we'll come back with a very strong Q4 for the year. So we're well on track with where we expect to be based on our publicly disclosed guidance and our internal budgets.
So, Charles, one thing I always like to ask you is just for, again, a recap, a rundown of the production growth, timelines, and different levels that we could see, not so much quarter over quarter, but year over year, even half year over half year. So, can you please provide us with a bit of that lay of the land if anything has changed recently?
Yeah, so I don't think it's changed this year. Half year, it'll be pretty even. So strong Q1, strong Q4, slightly weaker in the middle. For the 30 to 40,000 ounce production guidance this year, we've got a couple of scenarios that we expect to lock down by the middle of the year. That'll give us certainty on next year's production, but we're in a good position that we can expand production next year and lower costs. A big step change comes in 2028 when we bring Ana Paula online. We think that'll take us into that 150 to 200,000 ounce production range at materially lower cash costs. So that's a real step change for us as a business. And I think the most interesting part or the most powerful part from a can we make shareholders money perspective is we believe that we can generate between sort of 80 and 250 million in cash flow over the next 2.5 years. That comes from the stockpiles from the Veta Madre pit at La Colorada and the corner pit at San Agustin. The range there is whether you use 2,600 gold or $3,000 gold and a conservative and optimistic take on the stockpile inventory. We think that means that we can fund the bulk, if not all, of the non-project financing portion of Ana Paula without having to issue shares. So there's a few ifs and buts because we need a couple more data points before we can have some certainty there. But and we should know them by the middle of the year. But if we can deliver that kind of cash flow from our assets and we can get to that 150 to 200,000 ounce production range, that should be a materially more valuable company without having to issue any material share count to get there.
Yeah, that's a wide range, but that top end of the range, I'm sure that can fund a build.
Even at the bottom end of the range, that's still a significant cash portion of the capex of Ana Paula. So I think the bottom end is conservative, the top end is optimistic. I think you can look somewhere in the middle as the more likely outcome. and that sets us up very well to deliver what would typically be equity, but we will provide as cash to build Ana Paula.
Hey, considering what this time last year, you had zero cash flow, right? So it has been a pretty big step change for the company.
Fundamentally, I can't, provide more praise for the way the team in Mexico and our management team has built our vision for these assets. It's certainly been aided by the tailwinds that I talked about, but the team's performing strongly and setting us up really well. And you're right, it's been a great 12 months to be a shareholder of Heliostar. And if we deliver what we plan over the next 12 months, I think you'll look back and say the same again.
So, Charles, let's just get a quick update on Ana Paula then. The last time we chatted, you had just launched the drill program at Ana Paula, the largest drill program in the company's history of 15,000 meters just at Ana Paula. How's that progressing? Any insights you can provide us?
Yeah, so we've got two sort of workflows going in parallel. We've got the feasibility study. We're just about to lock down the flow sheet, which will then lock down the mine plan, which will then decide the tailings material, which will then inform the permit modification. Separately, we've got the 15,000 meter program where we want to convert a lot of inferred across to M&I. I think we can start expecting to see results from maybe late June, early July. Start to see them coming consistent drill results throughout the remainder of the year. There's going to be a lot more profile on Ana Paula in the second half of the year. So I think you can almost treat the first half of the year as attention on La Colorada and the second half of the year on Ana Paula. There's a lot of work going in the background. And I think we'll soon be able to sort of show the benefits of that as we lock down both the key study steps, the key capex costs, operating costs, as well as looking to grow the resources.
All right, Charles, thank you very much for this update. Again, Charles Funk, President and CEO of Heliostar Metals. Please, everyone, keep sending me your questions for Charles, and I'll get him to address those on future interviews. It sounds like still a lot of news to come out of the company, both on the production and exploration front. So, hey, Charles, really appreciate your time here. I know that you're a busy guy, so thanks for the update.
No, thank you, Corey, and thank you, everyone, for listening.